Welcome everybody to this Bonds Masterclass. We're so excited to have you here. AIB-AXYS Africa and Abojani Investments have collaborated to bring you this webinar where you have the opportunity to learn from the best about this investment option. And we are so excited to be here this evening. Allow me to switch off my video briefly as I introduce both the companies and today's panelists. AIB-AXYS Africa is the fusion of two established companies, AIB Capital Limited and Apex Africa Capital Limited, both with over 25 years of experience in the securities market. AIB-AXYS Africa forms part of AXYS Group, which is based in Mauritius, with subsidiaries in Switzerland, UAE, and Hong Kong. AIB-AXYS Africa's key services are stockbroking, bond trading, derivatives, and SLB, and corporate finance. We also provide online stock trading capabilities through the established brand AIB DigiTrader, the first fully automated trading platform in Kenya. Clients can open CDSC accounts either through the app or online platform, trade and make payments, including through M-Pesa, from the comfort of their homes. Abojani is a financial literacy organization who has partnered with us today. Financial literacy is the understanding of personal and corporate finance matters such as investing, saving, budgeting, compound interest, the stock market, among others. Abojani Investment helps professionals and entrepreneurs get the right financial education and build fully diversified investment portfolios to accomplish their financial life goals. In today's webinar, you will have the opportunity to listen to an industry leader within the bonds trading space, who I have the honor of introducing right now, Titus Marenye. Titus has over 10 years experience in the financial services industry, including 4 years in insurance, another 4 years in derivatives trading, and 3 years in fixed income. He has worked with UAP as an underwriter, as a senior derivatives dealer at Future First, trading on the Chicago Mercantile Exchange, the Euronext Exchange, and the Dalian Exchange, and of course, with AIB-AXYS Africa as a senior bonds trader since 2018. Thank you, Titus. And I am Nailante Kamodo, project leader with AIB-AXYS Africa, and your moderator for this webinar. Before we begin, some housekeeping. During the webinar, please write your questions, not in the chat room, but in the Q&A designation on Zoom. We'll have 15 minutes towards the end of the webinar to address all those questions, or as many as we can. With that brief introduction, let's dive in. So Titus, before we even get into why bonds, why we should be investing in bonds, maybe you can explain what a bond is and how it works.
Thanks a lot, Naila, for the introduction. Jumping straight in, probably just to take a bit of a tangent to have it encompassing what sort of holds the bills in the bonds. This and ideally fall under what we call the fixed income space, where fixed income is a financial instrument whose obligation is to pay periodic returns for a specified period of time. For example, you buy, for example, a financial instrument where you're putting up $1 million bob. This means that you'll, for example, earn 10% return per year for, let's say, 10 years. And that's ideally what encompasses a fixed income product. Now, diving deep into a bond and a bill, that's just a definition on the issuers per se. A bill and for example, a government bond. These are financial instruments that are issued by the government, for a case Central Bank of Kenya on behalf of Treasury. A bill happens to be any instrument that is short-term under 1 year that is issued as a discount. And for the bond, this is anything above 1 year. We have bonds all the way up to 25 years on a yield curve. And these key features for bond is that it's issued, for example, either at par, discount, or at a premium. One key salient feature is that it has what we call an interest rate, commonly known as the coupon, where it's the rate at which the bond pays every year a particular rate of return. And from then of course, it has upon maturity, then you get paid on your face value. Yes.
All right, thanks for that. You mentioned a bond and a bill, and the difference between the two is that a bill is less than 1 year and a bond is greater. Are there any other key differences? between the two?
Yes. So a bill is issued at a discount, and this means that ideally you do not earn what we call a coupon or an interest as a calculation of as what we call probably a calculation on the face value. A bill happens to have what we call a discount rate. Now, key example is if you're investing 100,000 and you're buying a treasury bill, let's say for a 364 treasury bill, you don't put up the 100,000 at onset. You probably put up around 92,000, and upon maturity after 1 year, then that's you earn your return, where the government will pay you at 100,000 as a maturity. Now, the rate that you earn is actually the difference. Sorry, not the rate. The amount that you earn is actually the difference between the 100,000 and how much you put in, which is 92,000. And then you have to calculate a return on that. Then it's as per your investment, which is 92,000. That's why you usually use a discount rate as per calculation. In terms of the bonds, that's ideally fairly simple. As I said earlier, it's just an interest rate that is calculated based on your face value, and then probably for just as an added feature, both bonds and bills are subjective to tax. For a treasury bill being 15% on the interest that you earn. For a bond, it has a more or less called reclassifications. We have anything under 10 years earning withholding final tax of 15%. 10 years and above, the rate is 10% tax on the coupon earned. And there is a third classification of bonds that we have in our market called infrastructure bonds. Now, these are tax-free, and then you can clearly see why, from what the government issues, that they're really, very competitive in terms of applications. Yes.
All right, thank you. That's a good explanation. So just to clarify, the return that the investor earns of the bill is the difference between the money that they are paid at the end and the money that they put up. And then the difference for a bond, what they earn is the actual coupon rates over the period of time until maturity. All right, that makes sense. You mentioned face value, par, discount, premium. Maybe you can clarify those terms.
A bond, and probably most financial instruments issued, is that they are subject to what we call an auction process. So an auction process is upon Central Bank of Kenya issuing a prospectus like what they've recently issued. Investors are invited to bid, and ideally they are lending money to the government. They would want to sort of price in what expected return they want to earn. So in that basis, how you calculate either the actual pricing, discount, premium, or par is ideally based on what the government accepts as terms of the average. For example, I'm bidding for a 10-year paper at 12%, and the government announces that the average accepted rate is 12%. So what that means is I've gotten my bond at par or at face value, meaning if I put in $1 million, Bob, then I don't have to pay any extra money. Now, in the assumption where I actually bid at 12.4, and the government the average accepted rate was at 12%, my yield, the yield that the government for my particular application was higher than the coupon, which is 12. That means then my application it was discounted, and more or less the inverse relationship between yield and coupon, and vice versa. So if I bid, for example, 11.5, and the government announces that the rate is 12%, then this means that I'll bid at a premium. Now, what a premium ideally means is you'll see a rate, for example, at par, you'll probably see something particularly for the pricing being done at 100. So at 100, it means you're bidding at flat, like for example, at 1. Now at a premium, this is anything above 1. So that's 1.01 all the way till I don't know, 200, depends, but it never really goes there. So on the case where you probably bid for a bond and you get a confirmation that your bond is accepted, but you're paying a premium of, let's say, 1.01, for example, 101. So you'll multiply this with your face value, and then that shows how much money that you end up paying to Central Bank of Kenya. And for example, for the discount, equally the same. So you'd use probably, let's say, 96, 97, multiply by face value, divided by 100, And then you realize that some bonds you buy probably at 980,000, and the bond you buy at, let's say, 1,010,000, 1,020,000. However, your coupon only earns based on your face value, which for this particular case is £1,000,000 bob. Now that's usually what defines the bidding process and why a bond can be issued either at par, discount, or at a premium.
And how does an investor know how to participate in this bidding process? How do they know to choose as they bid, what rate to choose?
Okay, so for starters, the most important part is the information that will be communicated, particularly by Central Bank of Kenya. An investor needs to be conversant of the bonds being issued, either bonds or bills that are being announced. This is information that is readily available from they usually announce this on newspapers. But recently, people are not reading physical newspapers as much as they would have. So what we as a firm have done also is that you subscribe to our research, you go into our website, you'll be able to subscribe to all the research we send out. We usually communicate this to all our clients. We'll indicate, for example, the bonds that are on auction. You also do what we call an auction note, and this is a macro perspective that we issue to all investors and just give them a sort of an understanding on how all particular bonds that are under auction, how they sort of look like in terms of rates. This is usually an indication of a couple of things. We might look at, for example, which particular bond is being issued in terms of tenor. Shorter bonds will always attract higher bidding. Longer bonds, then you see they'll have different different clientele looking at them. They probably have some banks, of course, insurance companies, pension funds, what we more or less call patient money. And then even in terms of the yield curve, we have higher returns on the long end. Now, with that, probably that information, we also indicate our recommendation in terms of the bidding process. Now, this, as you asked, what rate would you advise guys to do? Now, this is ideally indicated on an auction note. But more or less, one thing I sort of call a rule of thumb is for retail investors, you're putting in anything less than 20 million. More or less, the advice we tell you is just sort of put in the non-competitive rate. Now, why this is important is going back to my original example of a 10-year bond that the government announced at 12%. Now, Central Bank of Kenya would do an auction and say that they want to raise 50 billion, for example, and having guys apply, you realize at some point the bond is oversubscribed. Call it 80 billion, 90 billion, even more. We've seen even doing 120 billion on application for a single bond. Now, this means that the quantum Central Bank is trying to fill is only 50 billion. So at some point they have to reject money. And how do they determine rejection of money? They try to reject expensive bids. Now, expensive bids, okay, and this is quote as an inverse. So if they can afford to borrow money from you cheaply, and then they institute what we call a cut-off rate. So, for example, I'm bidding at 12. They've announced an average rate of 12%. They have a cut of, let's say, of 12.2. So my original bid, I was trying to apply for a bond so that I can get a discount, but I put in a bid of 12.4%. So this means that my bid was unsuccessful. So for a retail investor, the price differential between 12.4 and 12.2 is actually very minimal. You realize that the opportunity cost of investing in the bond and probably having your funds just sitting in your bank account, where at best you need to get, for example, a fixed deposit rate at around 4 or 5%, what banks give. It's not worth ideally just missing out on that particular issue. So that more or less informs bidding for anything under 20 million. Now, for anything about 20 million and probably higher, the idea is this particular class of people are sophisticated investors. They understand cost of capital, and then they'll be able to sort of have a fallback plan if they're very aggressive. And then even at those kinds of levels in terms of face value, differential, let's say 2 or 3%, 20 basis points, 30 basis points might be sort of sizable on their portfolios. And then you'd realize then you would, for in terms of application, you're bidding anything above 20 million. I'd recommend to sort of stagger your bids, try to put in different prices, so at least you have much more going through, as opposed to what's left on the table here.
All right, all right. Thanks for that explanation, Titus. And just understanding that AIB-AXYS guides investors on which bids to put in, and they also give investors information on what particular bonds and bills are on auction. How do investors get access to this information? Is there somewhere to subscribe, or what's?
Yes, ideally, just go to a website. We probably have it posted on the chat. There's a part under research, and just put in your details. Automatically, we get all our reports. We usually have a couple of them. We have, for this particular case, we have what we call the fixed income note. We have daily reports that are done in terms of market reports. We have sectorial analysis done that covers in equities, and probably what we'd call special reports that are probably done based on need, and all this information are there. The beauty about also how we do it is because of the periodicity of the issue by central bank being monthly for the bonds or probably weekly for the bills, we will definitely communicate this, and so you'll expect at least to have a weekly report done on Monday morning that just shows how the performance of the treasury bills has been. If you have, for example, a bond in between, we also do an auction note, and of course advise on how, for example, on the interbank, how the liquidity for banks is, and also all this are ideally macro considerations that sort of try to give more clarity in terms of expected return for an investor. So
Okay.
In terms of getting your information, just the website will be more than enough then with the reports.
All right, all right. And just noticing some questions in the chat. So let's go back a bit. And can you give us a practical example? Let's say I have 100,000 shillings. I'm bidding, I put in 12%. That's the return that I want to get. So that's the bid that I give. And let's assume it's successful in the case of someone who's bidding at a premium and someone who's bidding at a discount. How exactly will their return look? What will it all look like?
Okay, so probably just to simplify it, I'm putting $1 million bob. I'm earning 12%. That's my rate. I put in at average. So at par, when I'm bidding at par, it means that the government has accepted my 1 million. And from that, for the next 10 years, I'm eligible to get 12% return. Now, one thing probably I hadn't mentioned is that coupons are paid every 6 months. So you have, so you divide by the interest rate by 2. So every 6 months, you get paid 6%, of course, subject to withholding tax being removed upon payment. Now, in terms of the return, then just what you'll be earning is 12% less, 10% taxation. Now, if you're bidding at a premium, so you probably bought the bond at 1 million and 50,000 extra being the premium pay. Now, the premium is just a function of investment. So, because you're ideally trying to calculate what we call the yield return, yield to maturity, sorry. So, your interest will still be paid based on the 1 million. It's just that at onset, you'll pay an extra 50,000 to the government of Kenya. Now, what ideally does that mean? It's by default, okay, probably working back, it means that you actually put in more money for, I mean, an extra 50,000 for still the same 12% that is calculated on the 1 million bob. So your effective rate of return will actually be lower, probably call it 11.7 if you are to do the present value calculation on your funds. At a discount, and probably now you've put in, let's say, around 980,000. Now it's that you've gotten a benefit of not putting the full amount. So you have a discount of around 20,000 or 30,000. And that's ideally a saving you get, because now you still earn on the 1 million bob, but then your initial outlay was less. So probably as an example, that's how it looks like.
That makes sense. Thank you for that. All right. So what I'm understanding is, as you bid, your bid is very important, because if you bid at a higher rate than the average rate that other investors are bidding at, or the rate that the central bank accepts, then you're actually buying it at a premium. So you'll have to pay an extra amount. And if you bid at a lower rate, then you'll actually get that bond at a discount. And so your effective rate of return will be higher.
So just also to put this into perspective also, there are times we have options where all applications are discounted, or even all applications are at a premium. And this usually happens in cases, for example, reopen bonds. So a bond was issued 5 years ago, it had a very low coupon, let's say 10%. But when you look at the time to maturity, or let's say 10 years, an equivalent bond is being sold at 12%, for example. Now, all applications more or less equal around 12%, meaning you consider that with the coupon of 10%, then that means that particular issue will have all bonds, all bids being at a discount unless someone put in less than 10%. Now, there are also instances where on issue, particularly reopen bonds, then you realize they had a very, very high coupon. Let's say, call it 13, 13.5, even bonds that even pay 14% in our market. Now, when you try to look at the equivalent bond in the secondary market, or probably as a pricing point for that issue for a 10-year at 12%, and that has a coupon in a bond that has a coupon of 13, let's say 0.5, that it means all bids or applications will be at a premium. I think that's one thing that needs to be clear, is that it's not necessarily you have to bid or have your bond, buy a bond at par. Let's say that at $1 million for a particular case. And the most important thing that an investor should look at is the yield to maturity. What am I getting for my investments? Because whether or not I pay 980 or whether or not I pay $1,050,000, what determines my actual return is my yield to maturity for the amount of money I invest. So if I get a bond at a premium, it means that more or less there's a high likelihood that also my coupon is higher. And if I get a bond at a discount, there's a high likelihood that yes, I paid less, but in terms of coupon, I'm earning less. So it's one of those considerations where the most important bit becomes the YTM, or the yield to maturity, being the basis for review. Yeah.
All right, thank you. And the yield to maturity, is this rate readily available to investors?
So, yes. First of all, the yield to maturity at the primary issue, probably at the auction, is what the government offers as the rate for a bond. For the secondary market, this is you'd realize that we almost have almost 50, 60 bonds in the market, and at different tenors. So you can probably go to. You have to think, number one, our website you usually send out every Friday the NSC yield, what we call implied yields. So you can look at particular different bonds, different tenors, and see how the effective yield to maturity is for comparison on your investment or particular tenor that you're looking at. So you can have that probably just sent to you every week.
Okay, thank you, Titus. You mentioned the primary and secondary market. Maybe you can explain the differences in simple terms.
So primary market is, I think it's a fast point of contact for investor with a new issue. For example, the Central Bank of Kenya is trying to raise particular funds and issue a bond, and now they call for investors to apply or to bid for the particular bond. So that's what we call the primary process, primary auction. This also extends to corporate bonds, where probably an institution is trying to raise cash and reach out to investors, and usually indicates what we call the terms on offer. So on a prospectus, they'll indicate, number one, the issue number. You'll see a number like FXD1 2021, let's say 020. So that is it's a first issue of 2021 for the 20-year bond. Now, and a couple of things that you look at the prospectus. So you can get this also from Central Bank of Kenya website and look at the prospectus. Now, in terms of primary issue, now this is an application is done directly to Central Bank of Kenya. Now, once they accept the cash and you send all the investors pay money. So assume, for example, someone who's holding onto the bond wants to exit, or for example, when particular at the time of issue of a bond, you didn't have funds, but let's say 2 weeks later you were able to access some funds and you want to buy that bond. So bonds are available for trading on the secondary market a day after what we call the valid date. So valid dates are always on a Monday. So on Tuesday, going forward, bonds are always available for trading in the secondary market. Now, why the YTM becomes key in reference here is now that's how bonds are priced. So as we indicated, or probably as we were defining a bond, this is it has an interest rate that is issued periodically for the tenure of the bond. Now, every 6 months, a bond earns interest. So every single day, a bond will be earning interest. So when you're buying from the secondary market, you realize that some of the pricing, how someone would quote a bond to you would be number one, it's still the same thing, premium, par, or discount. In addition to that, you realize it have what we call accrued interest. So there's some few terms we usually use, and probably just to demystify the terms, you have what we call the clean price, you have accrued interest, and dirty price. So in simplicity, is the yield to maturity or the expected return of your investment is what you'll be trying to calculate on the clean price. Circling back to a 1 million example, you realize when you're doing a discount of, let's say, 98%, for example, 98 in terms of price, you realize that the bond will be discounted. However, since the bond is also earning interest, and let's say it has been the accrued interest in terms of days, let's say 40, each day has its equivalent interest amount that is earned. So you'll see a price like, let's say, 2.4 or 2.5. So the price of the bond would ideally be 98 plus the accrued interest of 2.4. It goes to 100.4. So this is what you end up paying in the secondary market. And of course, you're buying at par, then only the accrued interest comes into play. You're buying at a premium. You realize now the clean price becomes 102. Then you have your accrued interest of 2.4, leading to the dirty price. Now, the dirty price is simply your clean price plus accrued interest. And the clean price is a function of your yield to maturity. And yield to maturity now, in terms of definition, is actually your expected return for the bond for the holding period that you hold. Yeah.
Okay, great. I think you've demystified two terms that we always hear in the bonds market, but I've never understood: clean price and dirty price. So let's say an investor now has understood the yield to maturity. They want to start investing in these bonds. Where do they even start? Where do I start today?
So the process, so for one to invest in bonds, and I'd want to expand this a bit wide. Bonds actually, what we initially were mentioning was actually sovereign bonds, but you also have commercial bonds, corporate bonds in the market. So each has its ideally different approach in terms of how you access it. I'll start with government bonds. You have to have a CBK CDS account. Now, this is opened by visiting Central Bank of Kenya. They can go to either of the branches. They have Nairobi, Mombasa. They have what we call cash centers all over Kenya. They'll be able to offer you what we call mandate cards for you to open. You just take this to your bank, and they'll just do the KYC checks. And once you present this documentation to Central Bank, you have your account open. Usually it takes around between 1.5 to 2 weeks if all documentation is accurate. So once you have your account, then you look at the opportunities. Opportunities, as we talked about, can be either on the primary market and or the secondary market. And all these considerations are done based on you as an individual. How long do you want to invest? What kind of return am I looking at? What kind of quality, what kind of bond am I looking for? Am I looking for an infrastructure bond? Am I looking for a long-end bond that even after tax, my return is still equivalent to an infrastructure bond or even better? So all this determines how you sort of more or less look into this. Now, for corporate bonds, your CDS account for your equities would still apply to purchase the bond. So this is fairly easy and can be done from the AIB offices in terms of opening. And usually we have a couple of bonds that are on issue on the secondary market. We have a Centum bond, we have Family Bank bond that was recently issued. We have also Econ, and yeah, and of late we've seen two subscriptions in terms of corporate bonds. So we're getting a lot of I think confidence back to the corporate bond sector. So we hope to see probably more issues there. Yeah.
All right, thank you for that. We've understood how you need a CDS account. Does AIB help with this process of opening an account at CBK? Are there any fees, or does an investor do it by themselves?
So in terms of opening an account, you can ideally you have to go directly to Central Bank to open an account, and this is because they have to do the KYC checks. Part of the regulation around investor protection, and also in terms of AML and all that. This has to be done. The Central Bank of Kenya, being the CDS or the depository, they have to confirm the client who's opening the account, and also that the documentation in terms of who they are, PIN numbers, and all that are accurate. So you can still open an account through your bank, but they have to do through what we call a custodial account. Now, ideally, you can just approach your bank and just tell them you need to open up what you call a custodial account and that you can trade bonds in. The only difference between probably going directly to central bank and having your bank open an account for you is the fee structure. So central bank, ideally, when you're applying for your bond, there's no cost. Maybe just your leg just going to Central Bank of Kenya to actually open the account. When you go to a bank, they'll have what we call custodial fees, usually a percentage of how much you invest. So you need to weigh that and put that in perspective in terms of which of the two options you'd want to follow. But yeah, ideally, you can use the two channels to open an account at Central Bank of Kenya.
Okay, thank you. So once I've opened this account at CBK, I've looked at AIB research and I know what I want to invest in. What's the actual buying process, step by step?
So step by step. So I'll start with the primary application, both corporate or probably sovereign bonds. Once the prospectus is out and you identified the bond and you looked at our notes and you realize I want this bond, I want the 20-year bond that was recently issued. I want to put in, let's say, 500,000, and I want to purchase that bond. So the process is we at Central Bank as AIB, we are licensed to sort of do I wouldn't call it the application on your behalf, but once you fill in the application form, this can be downloaded from either our website or from Central Bank of Kenya website. You'll fill in the details. Number one, the issue number, the tenor of the bond, your name, details in terms of your account number, your portfolio number, and how much you're investing, and whether you want a competitive rate or you want to put in an average rate or non-competitive rate. Now, this from there you can just drop the form at AIB offices, usually in Westlands on General Madenge Road. Then from there, we'll organize to have this delivered to Central Bank, and on the auction and upon results, we'll communicate this to our clients. Yeah, so that's how you were able to purchase a bond on the primary market. On the secondary market, you might want a particular bond that is not on auction, either based on the tenor, based on the yield, or probably any other consideration. We have an interesting factor where, since a fixed income product will pay, or for example, bonds will pay periodic interest, there are people who want to do what we call cash flow matching. I want to get a bond that pays initially before they probably, for example, they amended the school calendar. There are people who wanted to have a bond that will pay coupon in December, a coupon maybe in March, June, just where they have financial outlays. And then you can sort of try to look for a bond that will have that kind of characteristics from the secondary market. Now, with that, we'll identify the bond. We look at the face value that you want to invest. We'll have an indicative yield to maturity, and once agreeable, then we'll quote the pricing to you. Which at this point now you have to fund AIB with the funds so that you can be able to execute on behalf and do settlement on your behalf. So that's how someone can buy a bond.
All right. Thank you, Titus. And now that we understand what it is, sort of how it works and how we can get invested, why should we even get invested? You had already mentioned one benefit that I noticed just now, where you said cash flow matching. So, for example, if you have to pay school fees, you look for a bond that will pay you interest payments around that time. But can you mention maybe other benefits of investing in bonds, even the returns?
So, the fixed income space, we usually call it a lazy way of making money, because the only thing you need to do is just buy the bond and you just sit pretty. Every 6 months you have money coming to your account without no effort on your end. So the only consideration probably someone has to look at is the risk involved. Now, initially you used to have the school of thought was that all sovereign bonds are risk-free. And maybe to a large extent they are, but recent history has taught us that at any one point, there's always some subject of risk. So you just need to understand in terms of what risk you're comfortable in. So far, for example, Kenya has never defaulted on its debt. So our history is actually very, very good. In terms of corporate bonds, we had a couple that have collapsed. And that's ideally, when you look at an investment, is to look at the risk-adjusted return. If I want to go into a high-risk investment, then what's the interest that I'll earn now? Maybe just to answer your question directly, why you want to invest in a fixed income space is the first thing you do is it's slower. It's a slow way of making good money. You don't talk, not slow, maybe slow is the wrong word. It's safer. Let me use safer. It's a safer way of making money. So when you look at comparable products, not comparable product, but investment product, comparable investment products that we have, maybe on the exchange or probably within our circles, you probably either put money and buy equities, put money and buy a piece of land, put money and maybe invest into a business. So you have to understand how the risk profile for all these lies. Fixed income products are very liquid. You want your money within probably 2-3 days, you'll get your money. That's one of the advantages we have. Decent pricing. We have what we call a stable yield curve, which means there's very few instances of fluctuation in interest rates, and most of the time, wherever there's probably an aberration, usually corrects itself very quickly. So you can plan better. As I said, for example, the cash flow matching growth is a very interesting way of how you can manage your expenditure. Another point people maybe have never realized is also how you can quantify maybe growing your wealth. For a bond that pays you 12%, you double your money every 7.2 years. Now, and this is an instance where the coupons that you earn, you have not reinvested them. Assume you can be able to reinvest the coupons you earn at the same interest rates of 12%, you actually double your money in a shorter time, almost around 5-point-something years. So particularly for the young guys, as you're building your investments, it's something that you look at and you see that slowly by slowly I need just to build my portfolio and grow it. And how you grow it is, number one, looking at good products. If you're young, you can probably even invest in the long end bonds that will give you a higher return. Number two, the coupons that you get, unless you literally have an urgent need for them, you can even reinvest them. So that's more or less what makes it ideal as a product, in terms of that the ability to build your wealth is consistent, stable, and you can see tangible results. Also, it's one of the few investment products where you can be asset rich and also cash rich, as opposed to what people say, asset rich and cash poor. So every 6 months you get money in your account. So you have liquidity in terms of cash flow, and also you have an asset you're holding.
All right, great. That makes a lot of sense. Thank you, Titus. And in terms of returns and benefits, is it the same for T-bills and T-bonds, or?
No. So it's like any other investment. If you're giving someone money for a short period of time, the likelihood of him paying you back is usually higher. And the longer it is, of course, then you can't quantify this 2, 10, 5 years, between 5, 10, 15 years. So you'd want to demand a higher interest rate. So you realize at the moment, for example, T-bills, anything under the 364 Treasury bill has a rate of around 7.6%. The 25-year bond that we have in the market, which is the longest bond we have, has a yield of around 13.5%. So when you look at that differential, you're talking about almost double. Now double the price. Now it's a function of time. If you want to earn, if you're young enough and you don't mind putting money that long, you're able to earn a tidy sum, and that's how it sort of makes sense to look at an investment. The idea is the longer you invest, and as with most businesses, the longer you invest, the higher your return that you'll be earning.
All right, thank you. And there's been a lot of fears around losing money in investing. Are you able to allay our fears or just outline the risks and how we can mitigate them when investing in bonds?
So, I think number one rule of investing is preservation of capital. I think that's, regardless where you put your money, that's one of the key fundamentals of investing. Now, for fixed income products, as we defined, there are various products we have in our market. We have treasury bills, bonds, corporate bonds, and what we call commercial paper, which ideally are corporate short-term investments. So it's a function of understanding what risk is. Unfortunately, for most communication that is always done to the market, people only look as a function of return. I'm buying a bond of 5 years and I'm earning, for for example, 11%, and I'm putting my money in a different investment, and I'm earning, let's say, 14, 15% for the same period of time. Now the question is why would I put in what pushes me to put in put my money in an investment that is earning 14%? What extra are they doing, or how risky is the entities that I'm investing in? And this is one of the reasons why information becomes key. And when you look at, for example, Central Bank of Kenya, that's why you realize most people are ending up putting their money at CBK, because they have a history of always paying the obligations and on time. So for other products, and you've seen our market, we have a couple of products. I mean, how people should view investments should be able to, I think, just do a deep dive in terms of either the entity or the management, for example, or that kind of thing. You want to make an investment where you have your bases covered, you have the right information. You're looking at, for example, even in equities, you're buying a share of a company, you need to look at the prospectus of that company. What are they doing? What is the outlook for that company? 5 years, 10 years. If there's a problem with their shock, are they able to absorb the shock, or will they collapse? And if you're able to understand that bit, then you'll be more comfortable putting money in an investment. One also function people should understand is at the end of the day, for you to earn a return, you must have risk on the table. The issue is how much risk. So what you need to balance is how much risk that you'll be looking at, and vis-a-vis how much return you want. Yes, that's the only thing you should look at. Yeah.
I see. So people need to understand the products that they're investing in, and but the CBK has a good history of paying back investors. So I would say that, or you would say that risk bonds have low risk.
Yeah, you look at the risk of all investments.
All right. Thank you. I want to give people, time has flown, and I want to give people enough time to ask questions. So before I move on to the Q&A, what particular bond instruments do you advise investors to take advantage of in the short or right now after this webinar?
So couple of things. One of the things you have to look at as an investor, just maybe not to have a blanket answer for all, is your individual, let's say, requirements. For example, are you putting money for 1 year, for 5 years, for 10 years? Do you want, for example, your investment to solve a particular need? Parent, pay school fees, etc. Now that informs number one, your tenor, how long you invest. T-bills, they're short term. Just need to park money for like 3 months. T-bill becomes your best bet. If I'm looking at a 5-year horizon, I'd go for a bond. If you're even more patient, and you're like, I'm 26 years old. I want just cash for my retirement. So you're talking about another, 25 years. Then go for the long end bonds. They give you a high coupon. It will be decent enough, and if you're reinvesting your coupons also, then it means that upon maturity. Sorry, upon your goal target of 25 years, then you have a sizable watches to sort of retire with. Yeah, so that's how I'd look at it. That being said, also another consideration is primary versus secondary. As you said, we have what we call infrastructure bonds. They're tax-free. We don't have them issued every single month, but in one, for example, financially, you'd have 2 or 3 times. I'd advise people to sort of look out for them. They the brilliant investment products. There's no tax on that. They usually give very decent coupon. Case in point, 2021, we've gotten 2 infrastructure bonds. And one is an 18-year bond, and the other a 16-year bond. Both are paying between 12.26 to around 12.67%, and this is tax-free. If you were to adjust this in terms of probably working back by 0.9, you're looking at technically tax, not tax adjusted, but with tax around 14%, and that's real value so far.
Yeah, great. Those are all great answers. Before we move to the Q&A, one final thing is, you mentioned 18-year bond, 25-year bond. If I, let's say, put my money into an 18-year bond, and after 3 years, an emergency comes up, I need the money, am I able to take it out, or I have to wait for the entire 18 years?
No. We mentioned about the secondary market, and this is how you look at liquidity. So there's price discovery number one on secondary market, and also our products are very liquid. So if you want to get out of an investment, it's very easy. All you have to do is just contact AIB Capital. We'll just ask a few questions. Number one, what bond you're holding, what's the face value, and also do you want to sell all of it? You can have, maybe you just need you had bought 500,000 bond, you just need 200K only. So you just sell part of the bond, not the whole amount. So this is fairly simple. We have a very liquid and deep market. You're able to get your money within probably 2 to 3 working days, because then you just look for a buyer and then do the trade. And the beauty about also bonds is once you sell your investment, the money is credited directly to your bank account, which is linked to your CBK portfolio. So yeah, so you just get money directly to your account.
Okay, thank you. All right, so we're going to move into the Q&A section just to give people sufficient time to ask as many questions as possible. Obviously, we can't handle all the questions, but we'll try our best. I also want to let everyone know that as far as you registered for the webinar, you'll be receiving a recording of the same. Okay, someone is asking, are there any minimums to investing in bonds or any minimum requirements that are there?
Yes, for treasury bills and for infrastructure bonds, the minimum investments is 100K. For normal bonds, it's 50,000. Normal bond, that says bond that the tax-paying bonds. So for IFBs and T-bills, 100K. The rest, 50,000.
Okay, and any fees that AIB charges to guide investors on this process?
So all such materials are free of charge. All you have to just subscribe for it. But in terms of execution, if you're buying or selling, if you're buying or selling in the secondary market, we charge the normal trading commission, usually 0.35%, 0.035% of your consideration on how much you pay. And I will do the simple calculation. It's minimal. It's not usually an expensive fee. So you can be able to purchase a bond for very little fees.
All right, and someone is still needing clarification on the risk of default by GOK. Is there a high risk, or should they be worried about giving a loan to GOK or investing in GOK?
So how I usually answer that particular question is this. If you have money in your bank account, your bank has bought bonds. So the risk is there. Whether you put it, the issue is, is my risk directly this because I've invested in Central Bank of Kenya, or is it indirectly through my bank which has already bought bonds? Because if you look at all financial banks, you realize they hold sizable either T-bills and bonds. Now, in terms of how much the bank default, the risk of GOK, as a sovereign, the government of Kenya has very many ways of collecting cash. The easiest, of course, we all feel it every now and then, is taxation. They just have to do, all they have to do if they have huge payments is just raise taxes and they're able to collect cash. The alternative, the most, not even Kenya, but all central banks would probably use, all governments would use, is they can just borrow more money and be able to sort of pay you and sort of push the obligation to the next generation. Because you're doing a 25-year bond, then clearly it's targeting your children to pay the bond, not you.
Okay, and on that note, does the election cycle affect the bond payments or bond investments?
No, bonds, the beauty about bonds is, as I said, particularly for sovereign, you're looking at the ability for government to pay money. So long as the government is able to tax its citizens, and also tax its citizens, number one, and also earn revenue through various ways, it's able to meet its obligations. So election cycles, whereas they happen and they affect other sectors, in terms of fixed income space, we probably see differential in terms of yield. Maybe the market can price in a bit of risk and have higher rates, but not in terms of default. Just maybe an area where you probably earn a bit more in terms of revenue, because then on an election year, you'd realize the government is is key on a couple of things. Number one, they wanted to fund the election, and usually a capital intensive, sorry, a high cost intensive endeavor. And number two, most election years, usually a lot of cash moving around, their projects to be completed and all that. So there's a lot of borrowing that happens in those years. And then by default, the government has to borrow, and if it has to borrow money, then it might end up being a bit more in terms of return.
I see. And someone is asking, does the coupon rate change over time? So once, for example, if it's 12%, can the CBK change this to 10% after 2 years? Or how does that work?
In terms of the most important bit when you're looking at an investment is the prospectus, particularly for the bonds. So so far, all bonds issued in Kenya, the coupon are fixed. They don't fluctuate. But if you look at other countries, particularly in the West, you might have even bonds which are called inflation-linked bonds that the pricing is usually based on the coupon. Locally, actually, we do have some corporate bonds that have a bit of differential in terms of how they calculate their coupon. Like the Family Bank bond, they had a feature where for one particular I think investment product, for some bidding, it was treasury bills, the T-bill rate plus I think 4%. I'm not too sure on that, but then it had a floor of 13%, meaning based on how the performance of treasury bills were, it could fluctuate. But government of Kenya and CBK, all bonds issued by them are always fixed coupons, so there's no variation in terms of coupon.
I see. All right. And what are the chances of a small bid being accepted, let's say 100,000 or 50,000? And does AIB help with that?
So the process itself it's primarily based on Central Bank of Kenya. They are the agent of Treasury to do the monetary policy around collecting cash and raising revenue through debt instruments. So an individual will apply for a bond, and they have the sole discretion to accept or reject an application. Unfortunately, for AIB, we have no visibility on what reasons they reject, but it's very simple. Number one, if you're applying a competitive bid and it's above their cut-off rate, it will be rejected. If, for example, you're applying a rate anything between 50 to 100K, as I said earlier, we usually recommend for you to do a non-competitive or an average bid, so that always your bond will be accepted in terms of your bidding process. So it allows you to, number one, allocate funds that will also be invested.
All right. And can those who are outside of Kenya invest in bonds? Would they go through the same process?
Yes. Oh, yeah. So you can invest in bonds as Kenyan citizens but living in the diaspora. So probably just to be clear, for you to invest in bonds in Kenya, you must have a bank account in Kenya. The bit about the innovation in our banks is that they've been able to open what we call diaspora accounts. You can open an account wherever you're in the world, and that can be channeled through your bank. As I mentioned earlier, I said that for one to open a bank account and Central Bank of Kenya, you can open directly, or you can use your bank to do this on your behalf. So you really see anybody who's outside Kenya in the diaspora who want to use the channel of your bank to open an account, because it's easier. They handle all that, and even for the fee structure that they'll charge, it makes sense because then they'll be able to do this on behalf. But if you're in Kenya, then directly makes most sense. So on the Central Bank of Kenya website, there are requirements for you to open an account. From the diaspora, they have all that, your details, KYC, of course. Unfortunately, you still have to have a Kenyan PIN, even if you've lived outside Kenya for a while. So that's one of the requirements that will be needed there.
All right, thank you for that. And Arnold is asking us, you mentioned that one of the benefits of bonds is that they can be liquidated or turned into cash quickly. But in the secondary market, he heard that selling a bond can take time because it takes time to find a buyer. Is this true or is this a myth?
So, well, it's there's still a couple of recommendations. So not recommendation. There's a couple of factors that determine how long a bond takes to liquidate. So number one is the issue that you have. So you realize that you might be trying to sell a bond and the rate at which you're telling your broker to sell at is not, the market is offering a different rate. So there's usually a rating issue, a pricing issue. For example, you want to sell expensive, the market want to buy cheaply. So that's really one of the recommended, you see it's a consideration in terms of selling a bond. Number two, also in terms of also the sizes, I have to be frank here. If you're trying to do a long end bond, we try to tell you anything less than, it's not a rule of thumb per se, but we usually see small ticket size bonds, 50K, 100K, particularly the long end bonds, taking a bit longer to liquidate. And the reason is the people who are primarily focused on that long end sector would be the funds, would be the ideal institutional investors, and then for them, then they have what we call, they have minimum ticket sizes, and these are trying to buy a bond. So if you sort of, I'd advise you not to just, number one, to understand how the market works, probably start with the T-bills. Number two, if you want to look at the bond with small ticket sizes, then maybe anything between short to medium is the best place to play, because then even in terms of sell, it's easier to liquidate those ones because they are usually a ready market there. So it's a couple of considerations there to look at. But that being said, these are, the Central Bank of Kenya also has what we call a I always forget this, a rediscounting rate. Yes, so in a case where you're not able to sell your bond completely, they'll rediscount your bond at 3% above the yield or coupon, whichever is higher, and they'll be able to give you your funds. So this is an option to just also get your cash from Central Bank of Kenya.
All right, thank you. And Naftali is letting you great presentation, but can you give us a practical example with 100,000 for 1 year and what the return would look like?
Now, I'm assuming you're buying a treasury bill or bond. It's not quite clear, but assume you buy a 10-year bond where you bought in the primary and you want to sell it also in the primary. You'll have two prices. The first price will be number one, you bought it at par and you sell it at par. So the only thing that you earn for 1 year is the coupon, which is 12%. Now, if you bought it at a discount, you realize also in the yield curve, the yields move, by the way. So it's never static. And when you're selling the bond after 1 year, it's no longer a 10-year bond. It's technically a 9-year bond. So we'll have a different pricing to it. So you really realize at some point when you're selling a bond, you even sell a bond and get some capital gains on your investment. So if I bought it at $1 million, Bob, then I'm selling on my clean price at around 1020, 1015. Sorry, at 1050, I mean $1 million and 15,000, and 15,000 being the accrued interest. So that allows it to sort of make a bit more there. If you are primarily focused on the treasury bills, 1 year 364, the rate is around 7.6%. I'm not quite sure on the numbers there, but I'm assuming you'll probably be putting in around 94K and earning around 6%, 6,000, 5,000 and something coming into your account at the end of the year.
All right, thank you so much, Titus. We'll have one final question, and we have Paresh, or I think this was already answered. So you can get information on what bonds are currently available on the secondary market from AIB if you subscribe to the reports that we send out from our bonds desk. So Paresh, there's your answer. Does one need a CDS account? Yes, you do need a CDS account from the central bank in order to start investing in bonds. Let's see if there's one more question that we can answer before the time is up. All right, so someone is asking, if you're offered at a premium, do you have the freedom to reject, or you have to give up the money?
So it depends. So if you're applying your bond at the primary auction, unfortunately, as long as your application is accepted, you have to cough up cash. So on the case where you don't, Central Bank of Kenya has the liberty to suspend your account so that you cannot do further applications. But it's at their liberty. They do, they don't. But for them as a government, if they're trying to raise 50 billion and they accept 50 billion and you don't give them your money, then they won't be able to achieve their borrowing target. And it's something that they take very, very, very very strict on. Now, if it's a secondary market and then you call us up and you want a bond and you tell you the price is a premium, now that's it. You have it. It's entirely within your purview to accept or reject, because then it's a willing buyer, willing seller in that space. So that would be ideal. That's how I would look at in terms of the two. Maybe just to review that premium, what is key is not that a premium is bad or discount is bad or better. I think the most important bit is to understand that you're looking at the YTM, the yield to maturity, your expected return. And for any investment, that is it. Just that in terms of pricing, sometimes you pay more, sometimes you pay less. But in terms of the coupon that you earn, you realize at times, most of the time that you pay more, you end up earning a higher coupon. So just more or less the function of how the market is set up.
All right, great. Thank you so much, Titus. And as we close, just some things to note. One, you can subscribe to receive those reports on the AIB-AXYS Africa website. If you go click on research, you'll be able to see subscribe to reports. So feel free to do that. We also have a Telegram group, which is open every Thursday to answer any questions from investors. So if there's some questions, for example, that are not answered here, you can come join our Telegram group, and on Thursday, we'll be there to answer your questions. Also, the recording will be availed to all registered attendees. That's within the week, so don't worry about that. And thank you again for attending. Thank you to Abojani for partnering with us for this webinar. Thank you to Titus for such a great presentation. And I hope you all enjoy your evening.
Thanks for attending. Cheers, guys.